The impact of cryptocurrency on traditional finance. Traditional finance has been greatly impacted by cryptocurrency, especially in the areas of banking, payments, and investing. There are multiple important dimensions that help explain this transformation. In this video, we will go into great detail about how cryptocurrencies are affecting conventional finance. Number 7. Decentralization and efficiency. Peer-to-peer transactions without middlemen like banks are made possible by cryptocurrencies, which run on decentralized networks. Especially for cross-border payments, this decentralization lowers transaction costs and increases speed and efficiency. While traditional remittance systems frequently entail expensive fees and protracted processing times, cryptocurrencies can enable quicker and less expensive international transfers. Cryptocurrencies simplify payments by doing away with middlemen, making them a more affordable option for both individuals and enterprises. Because there is no central authority to regulate or restrict transactions, cryptocurrencies are decentralized and therefore resistant to censorship and manipulation. As a result, people can transact without worrying about interference from the government or other institutions, which has important implications for financial inclusion and economic freedom. Traditional banking and payment systems may be disrupted by cryptocurrencies' efficiency and cost savings, which would force them to change and advance in order to stay competitive in the digital era. Number 6. Financial inclusion. For those who lack access to traditional banking in particular, cryptocurrencies offer an alternative. 1.7 billion adults worldwide do not have access to basic financial services. With just a smartphone and an internet connection, these people can store and transfer money thanks to cryptocurrencies, which encourage financial inclusion and may even spur economic growth in areas that lack banks. Cryptocurrencies have the potential to empower millions of people who have been denied access to traditional banking services because of obstacles related to geography, economics, or politics by offering a decentralized and easily accessible financial system. Cryptocurrencies are a desirable alternative for the unbanked, who might not have access to traditional banking infrastructure or might be discouraged by high fees or onerous identity requirements due to their low entry barriers and global reach. More people having access to financial services via cryptocurrencies may result in a rise in economic activity, the creation of jobs, and a decrease in poverty in underprivileged areas. But in order for cryptocurrencies to actually promote financial inclusion, measures to raise financial literacy levels and create user-friendly interfaces that meet the needs of the unbanked populace must be taken. Number 5. Investment opportunities. The emergence of cryptocurrencies has opened up new investment opportunities. Through the issuance of tokens, initial coin offerings enable startups to raise capital and democratize access to investment opportunities. This change presents a challenge to establish funding sources and gives people the opportunity to directly invest in creative projects. Because initial coin offerings offer investors a significant return potential and a substitute for traditional venture capital, they are becoming a more and more popular means for startups to raise capital. More oversight and investor protection are necessary, as the absence of regulation in this area has raised worries about fraud and scams. By enabling anyone with an internet connection to invest in promising projects regardless of their net worth, initial coin offerings have the potential to democratize access to capital. This could create opportunities for those who might not have been able to access traditional investment channels and level the playing field. The ICO market is unregulated, which has resulted in an increase in fraud and scams. Many projects have failed to live up to investor expectations or have even vanished with their money. Although more work needs to be done in this area, regulators are striving to create frameworks for initial coin offerings that strike a balance between the requirements for investor protection and innovation. Number 4. Challenges to traditional funding sources. ICOs and other cryptocurrency-based funding techniques put banks and venture capitalists in the crosshairs with traditional funding sources. Cryptocurrencies have upended the conventional financing scene by offering a decentralized and easily accessible platform for fundraising. The long-dominant banks and venture capitalists in the investment world are now up against competition from initial coin offerings and other cryptocurrency-based funding models. Although this change has the potential to empower more entrepreneurs and innovators and democratize access to capital, it also raises questions about financial stability and investor protection. Venture capital and other conventional funding sources seem slow and inefficient in comparison to the ease and speed with which startups can raise capital through initial coin offerings. Some have begun to wonder if the venture capital model makes sense in the era of cryptocurrencies as a result. However, the absence of regulations in the initial coin offering space has raised questions about possible fraud, market manipulation, and instability. It will be crucial for regulators to create frameworks that safeguard investors while promoting innovation and expansion as the cryptocurrency market develops. Number 3. Volatility and unreliability. The unpredictability of digital currencies as a store of value can discourage people from using them in regular transactions. The prices of cryptocurrencies are notoriously volatile, frequently changing quickly in response to speculative activity, news, and market conditions. Because of this volatility, cryptocurrencies may not be a trustworthy store of value since their value can fluctuate dramatically over brief periods of time. Because of this volatility, users and businesses may be reluctant to accept cryptocurrencies as payment methods because they don't want to hold onto an asset that might lose a lot of value before a transaction is finished. To ensure that cryptocurrencies are widely used as a form of payment, it will be imperative to address their volatility. The market's immaturity and the speculative nature of most trading activity are the main causes of cryptocurrencies' extreme volatility. It is anticipated that volatility will decline as institutional investors become more prevalent in the market and it matures. But because cryptocurrencies are decentralized, there is no central body that can step in to keep prices stable, so there will always be some degree of volatility. One strategy to address the volatility issue is the development of stable coins, which are cryptocurrency tokens linked to tangible assets like fiat money or commodities. Stable coins do, however, come with their own set of drawbacks and restrictions, so it's unclear if they can truly replace conventional fiat money. Number 2, regulatory concerns. Certain banks have restricted the purchase of cryptocurrencies because they are concerned about money laundering, fraud, and other illicit activities resulting from the lack of regulation. Cryptocurrencies are appealing for illegal activities like money laundering and the purchase of illicit goods and services because of their decentralized and pseudonymous nature. Regulators and law enforcement organizations are now paying more attention to this and are creating frameworks to monitor and regulate the use of cryptocurrencies. Citing worries about fraud and money laundering, some banks have responded by limiting or outright forbidding the purchase of cryptocurrencies using their services. It will be crucial for legislators to strike a balance between encouraging innovation and safeguarding the financial system and consumers as the regulatory environment changes. The cryptocurrency industry is unregulated, which has resulted in an increase in fraud, hacking, and other illicit activity. Public confidence in cryptocurrencies has been damaged by well-publicized events like the MingGox exchange hack and the Silk Road dark web marketplace, which have also caused regulators to be cautious about the possibility of abuse. However, overbearing regulation may hinder innovation and force cryptocurrency companies and users to relocate to other countries. How to regulate cryptocurrencies in a way that reduces risks and promotes responsible innovation is a challenge that policymakers are facing. While some nations have adopted a more lenient stance, others have outright outlawed cryptocurrencies. Because of the potential for criminals to use variations in national laws to conduct cross-border illicit activities, the absence of international coordination on cryptocurrency regulation has presented additional challenges. It will be crucial for regulators to collaborate in order to create uniform and functional frameworks for observing and regulating the use of digital currencies as the cryptocurrency market develops. Number 1, adaptation and integration. To stay competitive and relevant in the digital age, traditional financial institutions may need to integrate elements of cryptocurrencies as the cryptocurrency landscape changes. Numerous financial institutions, including banks, have already started looking into how to integrate cryptocurrencies and blockchain technology into their daily operations. Some are experimenting with blockchain-based solutions for trade finance and cross-border payments, or they have created their own digital currencies. Some have partnered with cryptocurrency exchanges or invested in startups that deal with cryptocurrencies. Traditional financial institutions will need to modify their business plans and adopt new technologies in order to stay competitive as the use of cryptocurrencies increases. Businesses that can effectively incorporate elements of cryptocurrency into their processes may be well-positioned to prosper in the changing financial environment. The assimilation of cryptocurrencies and blockchain technology into conventional finance holds considerable promise, including heightened efficacy, reduced expenses, and amplified transparency. For instance, smart contracts can automate a lot of back-office tasks, and blockchain-based cross-border payments may be more affordable and quicker than conventional wire transfers. However, there are risks associated with integrating cryptocurrencies, including heightened volatility exposure and the possibility of upending established business models. As they attempt to adjust to the shifting environment, traditional financial institutions will need to carefully navigate these challenges. To stay competitive and relevant in the digital age, established financial institutions might need to integrate elements of cryptocurrencies as the market changes. If you liked our video, please hit the like button and subscribe to our YouTube channel.